I have two rules. One is I never wear a tie, ever. And the second is I don't stand behind podiums. I absolutely hate them. So I thought about what I would say. Evening sessions are always difficult. Because especially if you've been 6:30, 7, you're fighting two things. One is you're hungry, you want to get to the dinner, and the second is you're tired. So I'm going to keep this basic. I'm going to keep this big picture. I'm not going to get into details. I'll give you a little bit of history. I came to NYU, New York University, in 1986 as an assistant professor. And when I was hired as an assistant professor, I was given a class to teach. The class I was given to teach was called Security Analysis. For those of you who have never heard of this class, it's a class that has a long and hoary tradition. In the 1950s, it was started at Columbia University by a guy called Ben Graham, whose most famous student, of course, was Warren Buffett. So in 1986, I show up at NYU. They said, this is the class you're teaching. I took one look and said, I'm not teaching this class. It's the most boring class ever. It's a collection of topics. There's 4 weeks on stocks, and 3 weeks on bonds, and 2 weeks on futures and options, and 5 weeks on institutional detail, listing requirements for this, listing requirements for that. And I said, I'm not going to teach this. It's boring. Not a great attitude if you've just been hired as an assistant professor. So I went to the head of my department and said, I don't want to teach this class. He's a good guy, though. He said, what would you like to teach instead? I said, I'd like to teach a valuation class. He said, don't do it. There isn't enough stuff in valuation to fill a class. You know what? He was absolutely right. In 1986, there wasn't enough stuff in valuation to fill a class. But I really, really, really wanted to teach this class. And I learned very early in my academic life that if you want to get anything done at a university, the best way to do it is to do it subversively. So you try to get official permission to do something, you know what would happen? A committee would be formed. Do you guys have experience with committees being formed? You know what happens when committees get formed? They're baby committees. They call them subcommittees and sub-subcommittees. They report to each other. It take them about 35 years to get done. And 35 years later, they'd come back to me and say, you can teach the class. I'd be too old to teach the class. So I said, okay, I'll teach a security analysis class. And I walked in and taught a valuation class. They have no idea what I do in a classroom anyway. You know how long it took them to catch on? In 2008, I get a call from the dean's office. They said, we hear you're teaching a valuation class. I said, yes, I've been doing it for 22 years. They said, we don't see it anywhere on the schedule. And I said, that's very easy to explain. I've been hijacking all these other classes you've been giving me and teaching valuation instead. They said, that's not right. We should call it valuation. I said, you're right. Call it valuation. So if you look at the NYU course schedule, valuation shows up for the first time in 2008. But this is a class that I've been teaching since 1986. And last spring of 2019, I taught this class for the 55th semester. And I'll say something about this class. No claps needed, no applause needed. I've just survived. Survival should never get just applause, right? That's minimalist requirement. But I'm going to say something about this class that encapsulates how I think about valuation. Everything I know about valuation, I've learned in the course of teaching this class. Notice how I said it. I didn't know it when I walked in. I've learned in the course of, I've changed over the last 33 years as I've taught this class. I've had to learn. And as I thought about what I would do today, I thought about compressing everything I've learned over 33 years of talking about valuation, thinking about valuation. I actually don't do valuation for a living. I've never been paid to do a valuation. I never want to be paid to do a valuation. I have the luxury of talking about valuation as somebody who just practices valuation in what I do. So I thought about taking my lessons and kind of compressing them and presenting them in about an hour, maybe a little more than an hour to do it, and presenting them as a series of big lessons. So I picked my favorite movie. In fact, when Rajiv asked what title should I give, I said, look, we take ourselves far too seriously in this profession. We're really not rocket scientists. We can add, subtract, multiply, and divide. You can do valuation. So I said, let's call it the Jedi Guide to Valuation. Star Wars fans? Can you switch to the slides, please? Okay. Do you see what the title says? Do you know who I'm channeling when I say, my valuation journey, have faith, you must? What Star Wars character is that? Come on. You've seen Star Wars, right? If you haven't seen Star Wars, we're pretty much dead in the water right now, right? That's Yoda, right? Have faith, you must. So let's take what I see as the lessons of valuation and kind of compress them and go through them. Let's start with the first one. I usually get the MBA. My typical class is 400 MBAs. I teach in an amphitheater. And I usually get them in the second semester of their MBA class. And when they walk in, an MBA class is very diverse. People who come into MBAs now have literature backgrounds, history backgrounds, some are scientists, some are museum directors. So often for many of them, their first exposure to what they think is finance is an accounting class that they take in the first semester. And that makes my life really difficult. Because the first thing I tell them is accounting is not finance. Let me explain. I'm going to say some very mean things about accountants right now, so don't take it personally if you're an accountant. Let's think about how accountants think about the world. Let's take the accountant's favorite financial statement, a balance sheet. It kind of encapsulates how accountants think about the world. First, accountants like to put things in boxes. There's fixed assets, there's financial assets, there's current assets, there's intangible assets. And the rules they follow are not consistent across the different boxes. When you have fixed assets, how do you record them in an accounting balance sheet? You look at what you originally paid for the asset. You dance this little dance about how much value it's lost. You call it depreciation, and you come up with a book value. So if I bought some land in Mumbai in 1955, and it's still in my balance sheet, you tell me it's worth nothing. If I believed you, I'll be giving away my business for nothing. Then I have current assets, inventory, accounts receivable, and here the rules are different. They reflect what I paid recently, and it's not because you were trying, but because my inventory has not been sitting around for 30 years. They're not financial assets, investments in other companies, and here your rules are all over the place. If I'm holding it for trading, you mark it to market. If I hold it for strategic reasons, God help me, I have no idea what you do. And you show a number. And then you come to intangible assets. Let's step back from the accounting precipice. Is it true that a large chunk of value for many companies now comes from intangible assets? In fact, if you take the 10 largest companies in the world, every single company's value comes predominantly from assets you cannot see. Apple's value comes from the technology, its styling. So it's very easy to see that intangible assets are a big chunk of value. Saying this is good, accountants are waking up to reality. But here's the problem. 85% of intangible assets in accounting balance sheets come from one item. The most ridiculous and absurd item ever created in accounting. You know what it is? Goodwill. It's an absurdity. It's a non-entity. It shouldn't even be treated as an asset. It shows up there. And here's what I mean about it being an absurdity. For goodwill to manifest itself on an accounting balance sheet, what does a company have to do? It has to do an acquisition. So let's not even pass judgment on paying more, paying less. So if you grow entirely with internal investments, there is no goodwill on your balance sheet. Take a look at Apple's balance sheet. There is almost no goodwill. You know why? Because they've grown almost entirely with internal investments. Their biggest acquisition is a tiny acquisition that they did 6 years ago. The minute I do an acquisition, accountants wake up and say, oh my God, there's goodwill on your balance sheet. And let's take a look at how accountants measure goodwill. I do an acquisition, goodwill pops up, and what is it? It's a difference between two numbers. What is it? What are the two numbers? The first is what you paid for the company, And the other is, let's see how much brainwashing you've gone through. It's not fair value, it's book value. And you know why accountants have a problem? Until yesterday, what were they telling you? The company's worth $2 million. The company, oh my God, it's worth $10 million. There's an $8 million mistake I've got to explain away. So I'm going to call it goodwill and pop it on my balance sheet, and I need to do it for a very simple reason. Balance sheets have this very unpleasant requirement, which is they have to balance. There is only one reason for goodwill to exist, which is without it, my balance sheet doesn't balance. So I put it in and I call it good. You know what the problem with goodwill is? It sounds good. And when something sounds good, you feel the urge to pay for it. You'd be amazed at how many emails I get every week from people saying, I'm valuing a company, it has $15 billion in goodwill. How much should I pay for goodwill? To which my response is, it's a plug variable. There's nothing behind it. Every year I send these suggestions to the Accounting Standards Board. They never seem to take my suggestions. So about 8 years ago, I sent a suggestion. I said, let's rename goodwill. In algebra, when you have two numbers that don't equate, it's very easy to make them equate. You just put plus x. So I said, let's call goodwill x. You open up a balance sheet, so x of 15, you never feel the urge to pay for it, right? It is a plug variable. There's nothing behind it. Now let's move to the other side of the balance sheet. All those inconsistencies accountants have with how assets get recorded manifest themselves on the liability side as well. When you have current liabilities, accounts payable, supplier credit, deferred taxes, they're recorded at close to current values. When you have long-term liabilities, bank loans, corporate bonds, they get recorded often at book value. What you raised at the time of the loan, that's what you see there, even though you might be in distress and you might have only a 30% chance of paying off the loan. And at the bottom of the liability side, you have the shareholders' equity portion. You know what goes into it? When I look at a company, I mean, I'm valuing ITC tomorrow as one of the companies in my seminar. When I look at ITC's balance sheet and I look at shareholders' equity on the balance sheet, what goes into it? Everything that ITC has done over its history is in there, right? From the time they went public and raised capital to every... In fact, mathematically, the shareholders' equity in an accounting balance sheet is a summation of every retained earnings at that company over its lifetime. So here's what I would say about accounting balance sheets. The first is they're backward-looking. Accountants are historians, and there's nothing bad about that. They record the past. The second is accounting is rule-driven. What do accountants do when there's a problem? They write more rules. Have you noticed this? You open up GAAP, you open up IFRS, it's about, you can't do that, you can't do that, don't even think about doing that, that's not allowed. Accounting is for 6-year-olds. It's about rules that you can... So accounting is backward-looking and rule-driven. As opposed to what? In valuation. I use a balance sheet, but it's a very different balance sheet. The way I look at a company is I don't care whether your assets are fixed or financial or tangible or intangible. I basically ask the question, how much of your value comes from investments you've already made as a company? I call these assets in place. And as I said, those assets can be tangible or intangible. And how much of your value comes from growth assets? You're saying, what are growth assets? These are investments I expect you to make in the future. I'm giving you credit for investments you haven't even thought about yet. You're saying, you're not allowed to do that. I'm allowed to do whatever I want. You give me a growth company, where does the bulk of my value come from? It comes from expectations about the future. I can't bring that onto an accounting balance sheet, but in a financial balance sheet, those are part of my value. I mean, Uber went public this year, right? $45 billion value. Or more than that, $75 billion value. Even on a good day, investments they've already made are worth probably $10 billion. The rest of the value is for what? Expectations of the future. You're saying that's speculation. Who are we to pass judgment on what's investing and what's speculation? It's a line that's a very gray line. And in financial balance sheets, rather than look backwards, I look forward. Rather than look at rules, I look at principles. I'm I'm very queasy about valuation rule books because I think they undercut good valuations eventually. Valuation should have base principles, and those base principles should drive how we think about valuation. And the more rules we write, the worse our valuations become. That's my problem with GAAP and IFRS trying. I mean, fair value accounting is an oxymoron. You got to make up your mind. Do you want to do accounting or do you want to do valuation? You can't tread both. You know, it's impossible to do. It's going to screw up our accounting balance sheets, and it's not going to be very good valuation that replaces. So I told you I was going to insult you as an accountant. Don't worry, if you're a banker, I'll insult you too. So a whole bunch of people I'll insult by the end of the day. So let's talk about the second big lesson. One of the things we're taught in valuation is discounted cash. We like to act like we've reinvented the word. So as many of you know, I value companies on my blog. I'm very high-tech, you know, very, very caught up in the 21st century. Basically, whatever I write, I put on there, and people comment on it. And so I valued Beyond Meat 4 weeks ago. This is this meatless meat company, and Uber 8 weeks ago, and Tesla 6 weeks ago. And I value the company, I put it on. And often people don't like my value for a company. They disagree with me, which is absolutely okay. And some of them become downright insulting. And one of their favorite insults is that I'm a theorist. I'm a practitioner, you're a theorist. And I have to laugh because I know how little theory there is in my entire valuation class. My valuation class lasts 15 weeks and 26 sessions. You know how much theory there is? It's one equation. The value of an asset is the present value of the expected cash flows. That's it. That's it. That's the entire class is about coming up with better estimates of the cash flows and better adjustments to come up with a discount rate on those cash flows. In fact, when I do my regular valuation class, I walk in with an envelope and I put a $20 bill in it. Act like I have an envelope with a $20 bill in it. I hold it up and say, how much would you pay for this envelope? Go along with me. Act like there's an envelope with a $20 bill. How much do you pay for it? If you pay $20 for an envelope with $20, what do you end up with? An envelope. Because all you do is swap the $20. So the first rule in valuation is if you know the value of something, don't start your bidding at that number. There's nothing left for you. Right? So start at $1. You don't know what disease I have. Maybe I don't read numbers. Of course, it's asking for too much. Even a banker can't screw up a $20 bill in an envelope. So at the end of that auction, you're probably going to end up at $20. Then I take a 3x5 card. Act like I have a $20 envelope with $20. We've got to $20 now. I take a 3x5 card and I write a word on it. Let's make it control. I put it in the envelope with you. And I ask you, how much would you pay for this envelope now? You now have $20 plus control. Go along. How much did you pay for that envelope now? Still 20. But I put control in there. I thought control was worth like 20%. Isn't that the case? Isn't that rule of thumb?
Not in this case. The $20
You will never make it as an M&A banker. That's a good thing, right? Because I tried exactly this experiment at Goldman Sachs M&A 6 months ago. It was for a re-education camp that they had for their bankers. You know why it's a re-education camp? These were experienced bankers who had forgotten their basic. They said, can you come in and do a session? So I held up the envelope, put $20, put control. A banker bids $25. You know what I did? I sold him the envelope. He said, I didn't mean. He said, now that it's your own money, you feel the pain, right? And think of what he did. He paid $5 for a 3x5 card, which I stole and wrote the word control on. And then I continue. Take my second 3x5 card and I write the word synergy. That's a good thing, right? I put in there, how much did you pay for this envelope now? Brand name. Put it in there. Still $20. It's just 3x5 cards with nice sounding words. I call these weapons of mass distraction. You know why I call them weapons of mass distraction? Because you finish a valuation, and what do people do? They say, what about my brand name? What about the fact that we have great management? What about this? What they want to do? They want you to add a premium on your valuation because they have a word that sounds good. So I'm going to state a proposition that I call the it proposition. It's a deep proposition. And here's what it says. If it does not affect the cash flows and it does not affect risk, it cannot affect value. Let me go back to those words I threw out there. What's the value of control? Don't think in terms of a banker or a 20% premium. What's the value of control? The true value. You get to run the company instead of the existing management, right? So to value control, what do I have to do? I have to value the company twice. Once with the existing management running it, and once with you running it. And presumably, if you can do a better job, what will I find? You will get a higher value with you running it than the existing management. That difference is the value of control. Could it be worth 20%? Yeah. Could it be worth nothing? Absolutely. We have a company that's already perfectly managed and perfectly run. And could it be worth 100%? If you have a company that's really badly managed and badly run, it could be worth 100%. I don't know where these rules of thumb come from. I don't believe a single one of them. What's the value of synergy? In fact, what is synergy? We use this word all the time, right? You see the word used. What is synergy? Two companies coming together are able to do something that they could not have done as standalone companies, right? So to value synergy, what do I need to do? First, I need to value the two companies standing alone. You can never value synergy by just valuing the target company. It's impossible to do. So when a banker claims or an analyst claims he's done that, it's not doable. You've got to value the acquiring company and the target company as standalone companies. And then you know what you need to do? You need to take the combined company and put in the specifics of synergy. Higher revenue growth, lower cost, and value the combined company. And guess what? Synergy could be worth a lot or it could be worth very little. In most M&A deals, you think people do that? They talk about synergy, but they don't want to give you specifics. You know why? Because they want to get away paying whatever they want to pay and call the difference synergy. It becomes a plug variable again. Let me close off with the value of a brand name. What's the value of a brand name? Every Indian company claims to have a brand name, right? The longer they've been around, the bigger their brand name value supposedly is. What's the essence of a brand name? Is you get to charge a higher price for exactly the same product. That is true brand name power. I tell people to walk into a pharmacy, walk to the painkiller section. You know what, this is true in India, but you walk into any part of the world, you'd see Bayer aspirin, and right next to it you see a generic aspirin. Exactly the same aspirin, trust me. Aspirin's been off patent like 100 years. But the Bayer aspirin will sell for twice the generic aspirin. And there will be people who will buy the Bayer aspirin. Why? They feel that if they take the Bayer aspirin, their headache goes away sooner. That's what brand name, it plays games with your mind. So to value brand name, what do I need to do? I need to look at your profit margins. If you truly have brand name, what should be true? Your margin should be much higher than the competition. The next time a company or a management or a founder or a promoter says, where is my brand name value? You might look at them and say, what brand name value? It's gone. So I've spent lots of money on advertising. I don't care. That's your mistake. I can't give you a brand name value if you threw money into advertising and you have nothing to show for it. So the IT proposition basically says, don't let words drive value. Look for what's behind those words. Second, the proposition I've named after my daughter. She's 23. I have 4 kids. They're all grown up. None of them are kids anymore. But with each of them, I noticed a very disquieting trend. Around the age of 2 or 3, they thought I knew everything on the face of the earth. They'd come to me with questions like, what's the meaning of the universe, Dad? And I'd make up stuff. And they believed it because they thought I knew the answer to everything. And sometime at the age of 2 and 3, they'd go to bed one night and I noticed something insidious happening. The next morning when they woke up, I knew less. And just downhill from there. My sons, my 3 sons, around the age of 11 or 12, became so self-centered they forgot I even existed, so they stopped thinking about me. But my daughter was obsessive about tracking how stupid I was getting and letting me know. So I got stupider and stupider and stupider. And I think there was a day when she turned 16, when she came to me and said, "Dad, I have to tell you this, but you've officially become the stupidest person on the face of the earth." And I had the misfortune at dinner of sitting across the table from her for dinner. And the topic of conversation would come up, where I think I had something to contribute. I'd open my mouth, and my daughter would look across the table and say, "Dad, duh." The amount of contempt that oozed out of that word was, I stopped talking for like 2 years. The good news is around the age of 18, I started climbing up the ranks again. I was no longer I became the 10th stupidest and the 25th. And I'm still in the top 500 stupidest people, but I'm kind of rising in the ranks. So here's what the duh proposition is for. Every week I get a few emails from people, and here's what they say. I'm valuing a money-losing company. I expected to lose money forever. Which of your valuation models do you think I can use to put a value on this company? Which you feel like slapping the person around the face saying, "Wake up, you have a money-losing company, you expected to lose money forever. Why are you thinking of paying them? They should be paying you." If any of you are thinking of buying Jet Airways, they should be paying you rather than the other way around. It's basically, it is the reality. If you're in a bad business and there's no light at the end of the tunnel here, the business is worth nothing. Which brings me to the third and most interesting proposition. You sit down to value a company and you project out the cash flows next year, and they're negative. What's your first reaction? This is terrible. My company has negative cash flows. Don't give up yet. If your company has negative cash flows up front, it can still be a valuable company if it can give you disproportionately large positive cash flows in the future. You know what types of companies you're going to run into where this is going to be true, negative cash flows up front? What types of companies will tend to have negative cash flows up front? Startups. And why do they have negative cash flows? Because they're right now not making money, and they have to reinvest huge amounts of money to get growth in the future. So you look at Nola or Flipkart, even on a good day, they're going to have cash flows that are negative as far as the eye can see. But you've got to hope and pray that the cash flows turn positive to deliver that offsetting value. When you see the valuation of young startups, do not be surprised to see negative cash flows up front. In fact, if you see the valuation of a startup with positive cash flows in year one, somebody's lying. Either this is not a startup, or you don't know how to compute cash flows. Either way, I should be terrified of what you're doing to me and step away. Very basic propositions, but let's step back from what discounted cash flow valuations have increasingly become. I'll tell you, one of the things I find troubling is, let me ask you a couple of questions. Do you think we have access to more data now than we did 30 years ago? Absolutely. I still remember the first time I valued a company in the early 1980s. I had to write to the company to get an annual report. And to collect companies' numbers on other companies, I had to go by hand into the library, get data on other companies, and put them into what? No Excel spreadsheets. I put them on a ledger sheet, and I was going to say an abacus. I'm not that old. No. But I used a calculator to compute every single number. So we have access to more data than we did 30 years ago. And we have access to more powerful models than we did 30 years ago. So now comes the key question. Do you think valuations today are therefore better than the valuations 30 years ago? It should be, right? You have more data, you have better models, you should have better valuations. I don't think so. And that, to me, is the great contradiction with what we have. We feed more data, we have more powerful models. And one of the reasons I think it's happened is increasingly, valuation classes have become Microsoft Excel classes. You become an Excel ninja, right? You know which buttons to hit to make every alternate row a different color. And in the process, I think we've lost control of valuations. When I look at valuing a company, I don't look at a spreadsheet. I look at answers to 4 questions. These are 4 questions you need answered no matter what type of company you value. First is, what are the cash flows I'm making from my existing investments? right? You've already made some investments on the ground. I need to know what those cash flows are. And to answer those questions, I look at your income statement, your balance sheet, your statement of cash flows, everything you give me from last year. That's an easy question to answer because I can get them from the financials. Here comes the more difficult question. How much value are you creating from future growth? Notice how I phrased the question. I didn't ask you what's your future growth. Because growth by itself is a mixed blessing. It gives you good stuff and bad stuff. Good stuff is it makes your earnings become a larger number. The bad stuff is to create that growth, you have to reinvest. The net effect from growth can be positive, it can be zero, it can be negative. Third, how risky are your cash flows? Why? Because if you have riskier, more uncertain cash flows, the value should be lower. And finally, when will the good times end? When will you be a mature company? Saying, who cares? I have a math problem, and let me show you what my math problem is. The previous page, I said the value of an asset is the present value of the expected cash flows on that asset over its lifetime, right? So if I give you a 10-year asset, you project cash flows in the next 10 years, you discount them back, you got a value for the asset. If you ask me to value a publicly traded company, what's the life of a publicly traded company? There's a corporate charter that tells you when the company is founded. When does it tell you the company is going to be wound up? Oh, it doesn't mention it. At least in theory, what can be true, the company can go on forever. And that means to value this company, I have to estimate cash flows forever. It's an Excel spreadsheet that never ends. That's my vision of hell. You're in row 16,380 and you're still projecting cash flows. So in the real world, what's the question? Can I stop now? How about right now? And I can give you an answer as to when and you're not going to like it. You can stop if you're willing to assume that beyond that point in time, your cash flows grow at a constant rate forever. You know what that buys you? It buys you an infinite series in mathematics. And 200 years ago, mathematicians solved for the value of that series. We stole that equation from mathematics, and we act like we invented this. But this is, of course, that terminal value equation you see in valuation at the end of every valuation. It comes from that math. But for that series to hold, your growth rate has to be constant forever. Now, let me get back to the question I asked. I said, when will your company be a mature company? You know what a mature company is? A mature company is one that grows at a rate less than or equal to that of the economy. Why do I need to know that? Because if you're going to be able to do that, then I can assume your cash flows are at a constant rate forever, and I can put closure, come up with a terminal value, and bring it back. So when I think about valuation, I think about answers to those 4 questions, and to me, a discounted cash flow valuation model is just a way of putting in my answers into the model. My base year cash flows reflect what you're making from existing assets. My value of growth I show in 2 places. One in the growth rate that I use, that's the good news. And then in the reinvestment that I put in to get that growth rate, which is the bad news. The net effect is going to determine whether growth adds value, does nothing for value, reduces value. My risk shows up in my discount rate. And when you tell me your company will become a mature company, I put that closure in a terminal value. Discounted cash flow valuations allow me to answer questions in a structured way and bring them all into my value. I'm not going to have a chance to go into the specifics of discounted cash flow valuation, but I'm going to throw out a few cautionary notes that I find increasingly problematic in discounted cash flow valuations. I don't know whether this is becoming part of the process in India, but around the world, one of the problems that appraisers and analysts face is they can no longer just stay in their local currency. 20 years ago, if you said, look, I'm an Indian appraiser. All I care about is rupee valuations. What do I care about dollars or yen or pesos or euro? I just said, you're right. Go ahead. The reality is, when we talk about valuation now, often we're talking about other currencies coming in. So I want to talk a little bit about why currencies matter and why they actually should not. This graph, it's a graph that I do every 6 months. I'm going to do the update in a couple of days for... I estimate risk-free rates in different currencies. Remember, the risk-free rate is a base from which you build everything off. And in some markets, you can get it by just looking at a government bond rate. In the US, for instance, you ask me what a dollar risk-free rate is, I use the T-bond rate. In Europe, you ask me what a risk-free rate is, I use the German euro bond rate. In Switzerland, you ask me what a risk-free rate is, I use the Swiss franc risk-free rate. But when I do that, what am I assuming? Governments have no default risk. Is that a safe assumption? Let me ask you a different question. Can governments default on government bonds? And usually people say, well, that's because you don't have enough dollars to pay off the bonds. I know right now you had this little mini debate about issuing sovereign bonds or not. So if you issue bonds in a different currency, that can, of course, open you up to it. But people often struggle with the notion of why would a government default in a local currency bond? Because there's an easy way to pay the bond, right? Which is run the printing presses a little faster. What's the big deal? So the argument is used, if I'm looking for a rupee risk-free rate, I can use the Indian government 10-year rupee bond rate, and the Indian government will never default in rupees because they can run the printing presses faster. You know that half of all sovereign defaults in the last 30 years have been local currency defaults? 53% of sovereign defaults in the last 30 years have been local currency bond. You're saying, why would they do it? It's true. You can run the printing machines faster and pay off your debt by running. But if you do that, what happens to your currency? You're going to debase your currency. You're caught between a rock and a hard place. Do you want to default or do you want to debase your currency? And you know what? Coming back from default is actually easier than coming back from debasing your currency. I go to Latin America, which is in a sense the centerpiece for sovereign default. This is the continent that says, look, we're the masters of sovereign default. They do it over and over again. So I remember the first time I went to Brazil was in 1997. This was 5 years after they'd gone through hyperinflation. You know what? Not a single Brazilian company would issue bonds in Brazilian reais because nobody would buy a real-denominated bond because they didn't trust the currency anymore. The Brazilian government would not issue bonds in real because nobody would buy their bonds. They had to issue bonds in dollars. So the reason Brazil started issuing sovereign bonds was not because they had a well-thought-through process, because they had no choice. Nobody trusted the local currency. They had to issue bonds in US dollars. It took Brazil 14 years before the Brazilian government was able to issue Brazilian real bonds, local currency bonds, because that's how long it took for people to get trust. You know how often Argentina has defaulted in the last 15 years? This is like every 4 years there's another. In any just world, nobody should ever lend money to Argentina ever again. But in 2015, I was in Argentina. It was the second coming of Argentina, the third coming. Every portfolio manager in the world was there. They were ready to forgive and forget. You know where I'm going next, right? The assumption that governments don't default in the local currency is just not true. Which means if you give me an Indonesian rupiah government bond, I cannot use it as my risk-free rate because if some portion of that bond is for default risk, I'm actually double counting country risk. Once through what I use as what I call my government bond risk-free rate, and once with the risk premium that I attach to the country. So I do a little cleaning up. And some people don't like what I do, but it's what I do. In any country where I perceive default risk in the government, I take the government bond rate and I subtract from the government bond rate the portion of the bond that I think is due to default risk. And I'm a little sloppy about how I do this. I'm open about admitting it. I get that measure of default risk in one of two ways. One is I look at your sovereign rating as a country, and I'll admit ratings agencies are not the sharpest knives in the drawer. They're always late to the party, but let's face it, they, on average, they do tend to capture default risk. So if you're a Baa2 rated country and you have a government bond, I'm going to take the default spread that goes with the Baa2 rating and subtract it from your government bond rate saying, I want a risk-free rate in rupees or a risk-free rate in rupiah. So see this red portion of the part? That is my risk-free rate in different currencies. So let's start with an observation. Risk-free rates vary across currencies. Some currencies have much lower risk-free rates than others. In this case, for instance, the risk-free rate in Nigerian naira or Turkish lira is much higher than the risk-free rate in Indian rupees, which is much higher than the risk-free rate in US dollars, which is much higher than the risk-free rate in Swiss francs or Japanese yen. In fact, the risk-free rate in Japanese yen and Swiss franc is actually negative. Kind of a mind-boggling concept, right? I mean, do you know that Danish homeowners last year, when they borrowed money to buy houses, you know what the banks had to do? They mailed them a check every month. You borrow money and they mail you a check. This sounds like a great deal, right? It's a mixed blessing, but it's what it is. So I'm going to ask you a question. This is going to go to the heart of what I call cracking the currency code. Why do risk-free rates vary across currencies? If they're truly risk-free, we know why government bond rates vary across currencies. Some governments are risky, some are safe. But if I've cleaned up for risk, why do risk-free rates vary across currencies? It's inflation. That's it. High inflation currencies will end up with high risk-free rates. Low inflation currencies will end up with low risk-free rates. And deflationary currencies could end up with what? Negative risk-free rates. 3 years ago, I wrote a piece on my blog on negative risk-free rates. And I wrote it because I got so many emails from people around the world, especially in Europe, saying, I'm valuing companies, the risk-free rate, my currency has gone negative, what do I do? It's a lot of heart-rending. I mean, the whole world had ended for them. I said, let it go. It's okay. Negative risk-free rates are unusual, but they're not unnatural. If you have deflation and negative growth, you should expect, it's not a good thing, right? The fact that the euro risk-free rate has turned negative is a very bad message for European growth in the future. But in terms of doing a risk-free rate, it is what it is. I take what I call the karmic view on risk-free rates. You know what that is? It is what it is. I can tell you what I wish the T-bond rate should be, but it's not mine to control. It is what it is. I'm going to build it in. And if you are consistent in how you treat currencies, your valuation should be currency invariant. You know what I mean by currency invariant? If I value Infosys in rupees and I come up with the value per share, and then I value it again in US dollars and come up with the value per share, I should get exactly the same value per share. And that strikes people as, how can that be? The cost of capital for Infosys in US dollars is going to be much lower than the cost of capital in Indian rupees, right? You're saying, so how can the values be the same? What else is going to change? When I value Infosys in Indian rupees, the growth rate I need to use is an Indian rupee growth rate with an Indian inflation rate built in. But if I value Infosys entirely in US dollars, the growth rate I should be using should be a dollar growth rate which reflects a lower inflation. What one hand gives you, the other hand will take away. You know what gets us into trouble? Is when you do your discount rate in dollars and your cash flows in rupees and expect your valuation to actually make sense. But it can happen so easily. I remember a student of mine called me about 2 years ago. He's the CFO of a very large US company. He was very proud of himself. He just bought an Indian company. And he wanted to call me to tell me how careful he'd been. So he calls and he says, we just acquired an Indian company. I remembered everything from your class and I did everything right. I said, tell me what you did. He said, we value the Indian company in US dollars because we think in dollars. I said, that's okay, right? And I said, you can value any company in any currency. That's a choice to make. That's fine. He said, to get the dollar cost of capital, we start with the dollar risk-free rate, the T-bond rate. We built up country risk premium. And then he went through the process and he said, okay, that sounds right as well. Then he said, we got the last year's financial statements during rupees. We converted to dollars so that we're doing dollar cash flows. And then we put a growth rate on them. And I said, where do you get the growth rate? He said, we talked to the managers of the Indian company and we asked them what they thought the earnings would grow at. And we think they were pretty unbiased. And they gave us a growth rate and we plugged it in. So I asked him the question. You know what question I asked him? Did you ask the Indian managers what currency they would think? If you ask an Indian manager about growth, what's your frame of reference if you're an Indian manager? You think in rupee terms. The growth rate they got was, they were not being deceptive. They were just giving the growth rate. We tend to think in the currencies we work in. So my recommendation to you is increasingly be explicit about currencies, especially when you talk to companies which have multiple currencies working around. When you talk about an interest rate, when you talk about a growth rate, and somebody says, I borrowed money at 6%, ask them in what currency. Because it makes a big difference whether you borrow the money at 6% in US dollars or 6% in rupee terms, because it's so easy to mismatch. Second, so much of what we do comes from looking at the past, right? For instance, when you talk about risk premiums, the way I was taught to estimate equity risk premiums, the price of risk in the equity market, is to look backwards. And I can understand why we do that, because there's no forward-looking number that's out there that's obvious. We look backwards. And in the US, that data goes back a long time. So you feel this sense of comfort because you have all this data backing you up. So if you ask me what the equity risk premium for the US is, I can go all the way back to 1928 and say the risk premium is 4.77%. And it looks pretty good, right? 90 years of data. But when I do that, there are two things I forget. One is, when I use a risk premium for the last 90 years as my risk premium for the future, what am I assuming about the future? I'm going to assume the future looks like the past. It's called mean reversion. Is that a good assumption? It's a good assumption as long as I'm working with a structural model that hasn't shifted. So much of what we do in finance and valuation has come from the US in the second half of the last century. And the US in the second half of the last century had the most mean reverting, stable, predictable economy of all time. You see where I'm going? This trust in the past comes from a market where trusting the past worked. Post-2008, I think we're in very dangerous ground making that assumption. I've not used historical risk premiums in valuation probably in 12, 15 years. And post-2008, I've never used it. Because to me, 2008 was a break from the past. It said, look, the model has changed. You can believe in whatever mean reversion you want, but you don't know what the mean is going to be. So what do I do instead? I look at a forward-looking estimate. I won't go through the specifics, but at the start of every month on my website, I compute a forward-looking risk premium for the S&P 500. Sounds fancy, but if you ever computed the yield to maturity on a bond, you know how you do that? You take the price of the bond, you take the cash flows, you solve for an internal rate of return. I do that with stocks at the start of every month. I take the S&P 500, project cash flows, and solve for what rate of return investors are demanding. It's not your job or my job to tell what the right price of risk is. This is a market set number, and that number goes up and down. It started this month. It was 5.67%. Every company I've valued in July, that's the premium I've used as my US risk premium. You're saying, what are you going to use in August? I don't know yet. On August 1st, I'll redo the numbers, and I'll update the premium. Let's talk about globalization. Another liability of becoming globalized is, even if you value just Indian companies, the reality is you're exposed to country risk. You have an Indian company that has operations in Africa. You've got to bring in the risk of that African market into your investment. So one of the things I've been doing for the last 25 years, at the start of every year, I estimate risk premiums for every country. I don't do it for you. I actually do it for me, because to value companies for the rest of the year, I need to know what the risk premium is in Nigeria if I want to value BP. British Petroleum, not Bharat Petroleum. No? But basically, for every company that is exposed. So I go through this process, and I cut to the chase of how I do it, because there's no mystery in how I do it. I start with the US risk premium on January 1st, 2019. So it started this year. That number was 5.96%. That becomes my base number. Then for every country in the world which has a sovereign rating, I look up that local currency sovereign rating. And Moody's, I think, rates 132 countries. S&P does. So basically, I combine all the ratings I create. And so I'll do the rated countries. So if you have a AAA rating, I take the easy way out. Germany, Australia, Singapore. I classify all AAA rated countries as mature markets, and I give them the US risk premium. So Germany, Australia, you see 5.96%. If you're not AAA rated, I look at the default spread. Remember we talked about default spreads taken out of the risk-free rate? I take your rating, I come up with the default spread. And then I apply a final adjustment. The default spread is what I would charge for buying a bond issued by a country. But I'm not interested in buying bonds. I want to buy equities. Are equities riskier than bonds or safer than bonds? They're riskier, so what I do is I apply a scaling multiple to it. I say, look, equities are riskier. To compute how much riskier, I look at how much the standard deviation, the volatility of equities is relative to government bonds across all emerging markets. So here's how it works. 5.96% is my risk premium for the US. Let's say the default spread for India is 1.77%. I multiply 1.77% by 1.23. I get an extra premium. I add that to my 5.96%. I now have a risk premium for India. I do this for every country. And when I'm done, I have a picture. This is my January 2019 picture. My July 2019 will show up in a couple of days on my blog. This is my picture of the world as I see it with risk premium. So let's focus on Asia. There, you look across Asia, you see across all of Asia, the weighted average risk premium is 7.43%. But you can see the wide differences in equity risk premiums across different countries. India, for instance, has an equity risk premium of 8.6%. Across all of Asia, Singapore has the lowest because it's AAA rated. You can see how risk premiums change. This is the most downloaded data set on my website. In fact, if you look at the top box, those are what I call my frontier markets. What are frontier markets? These are markets that are so scary that the ratings agencies don't send anybody there. They have no rating. Markets like what? Syria, Sudan, North Korea. Until about 2 years ago, I did not estimate risk premiums for those markets until I got an email from a Syrian business person. There's actually one guy left in Syria, I think, running a business. And he said, I need hurdle rates to take projects. I was looking on your website for an equity risk premium for Syria. How come there's none? And I told him, look, there's no sovereign rating for Syria. There's no sovereign rating. And he said, so how do you expect me to take projects? I said, I don't know. Maybe get out of the country altogether. But I said, you have a point. Let me try. In fact, starting 2 years ago, I used these political risk scores. These are like numerical scores for countries. And you have them for North Korea and Syria. I look up other countries with similar scores on which there's a rating, and then I attach the same risk premium to the country. I know it's very sloppy, back of the envelope, but I think I pretty much the whole word here. It's by far, as I said, the most heavily downloaded data set on my website. It gets used in the strangest places. I don't control how it's used. I've given up on it. And I get emails from people using it. Most of the time, it's technical. I remember getting an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand until I got this email saying, we're using your country risk premiums to set milk prices for New Zealand farmers. What? Who are you selling the milk to? Zimbabwe? Okay. How do you come up with the risk premiums? And I have a little PDF file I've created. So this is how I do it. It's no rocket science. But once in a while, I do get an email I don't know how to respond to. I remember in April of 2009, I get an email from a Lebanese business person. I open it up, and I'm very excited. I don't get that many emails about valuation in the Middle East. And here's how the email begins. You have destroyed Lebanon. What? After 30 years of civil war in Hezbollah, I'm the guy who destroyed Lebanon? So what did I do? And the Lebanese business person had had his business appraised, and the business appraiser had used the risk premium for Lebanon from my website to value the company. He's saying, so what? Take a look at Lebanon. That number was 17.5% in April of 2009. You put in a 17.5% risk premium, what happens to your discount rate? It's going to go through the roof. Your discount rate goes up, what happens to your value? It collapses. This guy felt he'd been gypped. It was all my fault. My reaction was, hey, you paid your appraiser, you didn't pay me, take it up with them. But then I remember the email was from Lebanon, so I decided to be a little careful about how I answered. I said, it's not my fault. You see whose fault it is? What do? I start with the US premium. Then I look up your rating on Moody's. And if your rating is in the toilet, guess what? You're going in the toilet with it. And I said, it's not my fault. It's Moody's. And if you want to have an address to put in your GPS, here it is. It's got nothing to do with me. It's basically a reflection of the fact that your rating has collapsed. There's no intellectual firepower behind these numbers. But the reason I need them is to value a company, I need to have the entire schedule. Now, so if you took Infosys, I did a valuation in 2017, the last time I was here. Infosys is an Indian company. But guess where it gets its revenues? It gets almost, if you look at the percentage, 62% of its revenues in Northern Europe, 22% in Europe, 12% the rest of the world, and 3.19% in India. It's an Indian company. When I value Infosys, I have to remember that it's an Indian company with its exposure in the rest of the world. When I used to value Infosys, that was the equity risk premium I built in. Can you imagine valuing Coca-Cola? Coca-Cola is a US company in name. Its headquarters in Atlanta, but 65% of its revenues come from emerging markets. Risk doesn't come from where you're incorporated. It comes from where you do business. And this is my way of bringing that into the valuation. Final point about valuation, then I'll move on to the next topic. When I look at valuation, and I look at a lot of them, I've used what I call my valuation triangle to check for consistency. And let me explain what I mean by that. There are three sides of the triangle. There's growth, there's reinvestment, there's risk. Sounds fancy, but let's say you send a DCF to me, say, can you take a look at this? I'm first going to check your growth rate. What are the three possibilities? You could be estimating high growth, low growth, or no growth. And I'm not going to fight you on it. It's your company. You know more about the company than I do. So if you put in high growth, I'll say, okay, high growth. Then I'm going to go check your cash flows to see how much you're reinvesting in plant, in equipment, in whatever you need to reinvest in. And if you have high growth, what should I expect to see in reinvestment? High reinvestment, low reinvestment, or no reinvestment? I should expect to see high reinvestment. And generally, when I look at risk, I should expect to see high risk. High, high, high makes sense. Low, low, low makes sense. High, low, low, I'm going to push back. Tell me how is it that your company can grow fast without reinvesting very much and with very little risk. And if you can give me a good story, I'll step back. But this is my way of checking valuations for consistency, because without consistency, valuations kind of fall apart. Point about growth that I want to re-emphasize. Growth by itself does not create value. You can grow and add value, grow and destroy value, and grow and do nothing for value. I think we pay homage to growth too much. And let me explain why I'm so cynical about growth. Start of every year, the way I create my data sets and come up with industry averages is I download the data on every publicly traded company in the world. So this January when I did this, there were 43,000 publicly traded companies in my sample. It's a gigantic Excel spreadsheet. Then I compute two numbers for every company, the cost of capital for every company. And I do everything in US dollar terms so I can stay consistent. So I have the cost of capital for every company. And I also compute the return on invested capital at every company. Don't fall too much into the trap of the specific. Return on invested capital just measures what you make on the capital you've invested in the company. And what do you need? What's a rule in businesses? And it's a very simple common sense rule. If your cost of capital is 9%, what should you try to do? Earn more than 9%. That's not rocket science, right? Every good business person through time has known that. So I compute the return on capital and cost of capital of every company. You know why I do this? I want to see what percentage of companies globally create value when they grow, how many destroy value as they grow, and how many do nothing, just run in place. And the numbers to me are frankly depressing. See these green numbers? Those are the companies globally that create value. They have a return on capital greater than the cost of capital. So about 22% plus, about 30% of companies, rounded up, have a return on capital higher than the cost of capital. About 12% of companies pretty much run in place. They earn roughly their cost of capital. 58% of companies globally last year, as they grew, destroyed value. The reason I say that is in markets like India and China, one of the big sales pitches that companies make is, we're a growth market, we're going to grow. To which my response is, that's nice, but should I be running for the exit doors when you say we're going to grow? Because you can grow and destroy value as you grow. In fact, yesterday when I was on the flight from Chennai to here, I was thinking about a reality. I mean, let's face it. Has there been a big growth in the airline business in India in the last 30 years? Do more people fly than used to? Obviously, right? So if I graphed out number of airline passengers, revenues from the airlines, it's all this huge, the line looks like it's a huge growth line. Let me ask you a follow-up question. How many great money-making airlines are there in India? None. You can have growth and have businesses not able to make money off that growth. And the sooner we start separating the two, the healthier growth becomes. Not all growth is created equal. So this is my cautionary note. Don't think of growth as a good thing. In some companies, they say, I want to grow. You should be saying, don't. You're better off not growing. And finally, on the cost of capital, one of the things I try to do to keep perspective is I compute the cost of capital for every one of those 43,000 companies, and I put in a histogram. Remember histograms from statistics? Basically, I just count the number of companies, cost of capital. So the reason I do this is I actually, at the end of the process, can tell you what the cost of capital for a typical company would be in a global market, in a mature market. And it's what I use to gain perspective. So when you send me a valuation of an Indian company, if I see a 5% cost of capital, I'm wary because the median cost of capital for an Indian company in rupees is closer to 12%. What I use this histogram for is when I look at a valuation to make a judgment. Is that cost of capital a number that looks okay given how the cost of capital are distributed? And I'll tell you one other thing. In valuation, I think we spend far too much time on discount rates and far too little time on cash flows. Spend more time on the revenues, the growth, the cash flows, because that's where the big mistakes in valuation get made. Finally, don't let your macro views climb into it. You know what I mean by macro views? What do you think will happen to interest rates? What do you think will happen to oil prices? You're going to be tempted, but it's better to keep your macro views out of the valuation. I'll give you a very simple example. When you sit down to value an oil company, let's say it's Royal Dutch. You know what the key driver of value at Royal Dutch is? What happens to oil prices? So you're going to be tempted to project out oil prices. So let's say you are an optimist on oil prices. You think they will double over the next 5 years. If you put in that projection into your Royal Dutch valuation, what are you going to find? Company's worth a lot. You're saying, so what? Then if you ask me to buy the company, I'm not sure whether you're asking me to buy the company because you like the company or because you think oil prices will double. You're saying, why should I care? If you're really telling me to buy Royal Dutch because you think oil prices are double, I'll tell you something. There's a much easier way for me to make money than buying Royal Dutch, which is to do what? Go buy oil price futures. If you're that good at forecasting oil prices, what the heck are you doing valuing Royal Dutch in the first place? And that's, I think, part of the problem is when analysts start to bring in their views on interest rates and exchange rates and commodity prices into valuations, what you end up with is a strange mishmash in the valuation, not quite sure what to do with it. So let's talk a little. So I'll just show you my ITC valuation that I'm going to show in my class tomorrow. Don't do anything crazy about it. I know I'm staying at the ITC Maratha while I'm doing the valuation, so I'm afraid of what will happen the day after, because I don't like the company. To me, this is a company. If anybody from ITC, don't take this personally. I just don't like the company. It is a cigarette company. No matter what you frame, you're saying, but they have hotels, they have consumer products. This is a company that gets the bulk of its cash flows from cigarettes. The problem they have is the cigarette business is stagnant. Thank God for that, because I don't want any more cigarette smoke blown across my face. It's stagnant. And the company has taken the cash flows in the cigarette business and directed into hotels, into consumer products. And the reality is none of those other businesses create value. The cigarette business feeds. So that's what I see in the company, and my valuation reflects its story. So the growth you see there comes almost entirely from them trying to grow another business where the margins are much lower than in the cigarette business. And that's going to show up over time in my valuation. In fact, one of the points I'm going to make is every valuation tells a story. And my story for ITC is not an upbeat story. But it's not my fault. It is what it is. It's a cigarette company trying desperately to get growth, and that growth is coming from businesses that don't have the kinds of margins and returns the basic cigarette businesses. I'm not saying it's going to go bankrupt or be distressed. It's going to be a company that's around, but it's not a company where there's going to be much upside from growth, because the growth is happening in businesses where their competitive advantages don't kick in. A few years ago, about 4 years ago, I wrote a post on what I call dysfunctional DCFs. If you get a chance, you can read it. Right? Basically, it's about all those terrible DCFs that I see, and I put them into the hall of shame of bad DCFs. Yeah. So I won't go into specifics, but one of my favorites is what I call the kabuki DCF. What a kabuki DCF is? This is valuation where you start with the number you want to see. And then you reverse engineer into that number. Let's face it, most fair value accounting valuations are kabuki valuations. You're not trying to search for the truth. You have a number and say, how do I get there? You have dreamscape valuation. You know what those are? These are companies that can exist only in your dreams or on spreadsheets. I can create some amazing companies on spreadsheets. You have robo-DCFs. Robo-DCFs are DCFs where you're not sure who's running you. Who? Are you running the model or is the model running you? It's like, it's a race. And you have mutant DCFs. A few months ago, I got an email and multiple posts from somebody who said, I valued the Indian market and found it to be massively undervalued. He'd done a DCF, he said. And here's what he had done. If you're in the room, don't identify yourself, I don't want to know. He took the earnings for Indian companies and discounted them. First, what do we need to say? Earnings are not cash flows, because if you can pay your entire earnings out, how the heck are you going to grow? He put a 20% growth in earnings forever. And he put a 7% discount rate. I'm amazed he ended up with a positive value, because 7 minus 20 is negative. Your terminal value should have blown up. But just because you discount a number doesn't make it a discounted cash flow valuation. You discounted the wrong number. You discounted earnings instead of cash flows. You made up a discount rate. And then you tell me that stocks are massively overvalued. There's nothing behind what you've just said. But again, people think that if they discount a number and they come up with a value, that they've done a discounted cash flow valuation. I know I'm running out of time, so let me kind of cut to the chase on the other lessons I hope to bring through. I mean, as I said, one of the things that troubles me is the fact that we've increasingly become spreadsheet-driven in valuation. Right? One of the questions I asked my class at the start of the class, I said, is, and I can throw this question out to you. If I asked you to describe yourself as a person, would you more naturally think of yourself as a storyteller or a number cruncher? Think about it for just a moment. What comes more easily to you? Working with numbers or telling stories? Because each of us has a strength. I'll tell you what mine is. I'm a number cruncher, naturally. And when I first started teaching valuation, I taught it as a number cruncher, that focused on numbers, equations, models. And I discovered very quickly that this wasn't taking me very far. Because if all you have are numbers in a spreadsheet, you don't have a valuation, you have numbers in a spreadsheet. If all you have are stories, you don't have a valuation, you just have stories. A good valuation is a bridge between stories and numbers. You know what I mean by a bridge? You show me a valuation of a company, and I point to revenues in year 10. Say, why are your revenues $2 billion? I don't want your answer to be, I used a 30% growth rate for the next 5 years and 10%. That doesn't answer my question. I need to know your story for the company that justifies your revenues. In a good valuation, every number will have a story attached to it, and every story you tell me about the company will have a number attached to it. And I've struggled with this, because I had to teach myself storytelling. I think I'm better at doing this now than I used to be. But it's been a struggle. I've had to learn storytelling. So as an example about the way I do this, in fact, when I think about it, is I go through a 5-step process. You give me a company to value. Here are the 5 steps I go through. First step is I try to tell a story about the company. Notice, that's a step 1. I don't open an Excel spreadsheet and I have a story for the company. Second step, I make sure the story I've told you is possible. I'm not told you a fairy tale. Is plausible, which is a higher standard, and probable. I call this the 3P test. I basically pass it through the test. Third step, I take the story and I break it into numbers that become inputs into my valuation. Every story you tell can become numbers. And once I do that, step 4 does itself. I have a value for the company because those inputs give me a value. And then comes a step that most of us don't want to take, but it's well worth taking. When you finish a valuation and show it to other people, what do you want them to tell you? Amazing job. This is exactly how I'd value the company too, right? And if you hang out with people who think just like you, who've read the same books you did, follow the same rules you do, guess what? You're all going to pat each other on the back saying, this is amazing. We all agree with each other. My advice to you is when you're done with the valuation, seek out people who think least like you. Present your valuation to them and learn from the feedback. And it requires a thick skin because they're going to tell you that everything you did was wrong, and it's probably not wrong, but listening to people will make your story better. So I do a session actually on narrative and numbers, connecting stories to numbers, where I go through this process with 2 companies. Uber in June of 2014, and I explained how I valued Uber, and Ferrari in October of 2015 at the time of their IPO. In the case of Uber, I valued them as basically the story I told about Uber was, in June of 2014 was they were an urban car service company that attracted new users into the business and essentially continued to do things the way they did, which they didn't own the cars, didn't hire the drivers, and kept 20% of the fare. My valuation reflected that story. In fact, every single input I have, I tell you what part of the story backs that input. So when you see my valuation, you can go to the input, but then each input is tied to, this is the story I'm telling about the inputs, because without it, all I have is a collection of numbers. You know, I valued Uber every year since. In fact, at the time of their IPO a few months ago, I valued them again, and in that valuation, I kind of gave you my updated story for Uber. A very different story than the story in June of 2014 because the company has changed, the market has changed, the world has changed. One final point about stories. There are some companies that I call story stocks. And here are the characteristics of a story stock. The first is, it's usually a young company. A young company in a big market. Why? It's going after the big, and it has a storyteller, and a storyteller who's a great storyteller. Young company in a big market with a storyteller becomes a story stock. And one of my favorite examples for this is Tesla. It's a company I valued every single year for the last 7 years. It's a stock that's fascinating. Everybody's familiar with Tesla, right? I mean, this is, of course, Elon Musk's vehicle. It's a company that morphs every day. The story, you're not sure what the story is. One day it's a car company, the next day it's a battery company, then an energy company, then a boring company. Who knows what it will be tomorrow? So the story shifts on. So about 2 years ago, I decided to value Tesla, and I looked at the possible stories. First, I said, what business is the company in? Maybe it's an automobile company, maybe it's a technology company, maybe it's a clean energy company. Then I said, what's its focus? Is it on the high end of the market, or is it a mass market company? Third, I said, what's its competitive edge? Is it because they were there first, they produced the first viable electric car? Is it because of the style and the brand, or is it because they have superior technology? And I said, when they invest, are they investing like a manufacturing company, like a typical automobile company, or can they get away investing like a typical technology company? And finally, is their risk going to reflect the risk of an automobile company or the risk of a technology company? And you can see, given the choice I make, I can come up with very different stories for the company. And those very different stories essentially are going to pay out as very different inputs and very different values to the company. In fact, I ended up with a table that reflected, given my choices, what the value of the company would be. And they range from minus $60, which means the company is going to go bankrupt, to $316, depending on how I frame the story for the company. I'm a great believer in starting with stories, because without stories, all you have are collections of numbers, and those numbers, in a sense, will play out in your final valuation. In fact, my ITC story is right up there. And as I said, it's not an upbeat story. It's a story about an aging company that is using its cash flows from a business that is stagnant to try to grow. And I think that story has never ended well in any part of the world, right? Because you keep stretching into businesses you're not that good at. Those cash flows eventually start to dry up, and my valuation reflects that end game. Let's close off a few more lessons. Would you rather be precise? Would you rather be accurate? You say, what are you talking about? Aren't they the same? I'll give you the difference between precise and accurate. You know, you've ever played dart? Precision basically means that you get all your dots in the same spot. Accuracy means you get your dots close to the center. So of course, you'd like to be precise and accurate. That's the first one. The second one, you're precise, but you're off the center. You're getting all your dots in the same place. The third place, you're accurate, but not precise. And the fourth place, you're neither. But let's pick these two. Would you rather be precise, or would you rather be accurate? In valuation, what's the end game? Would you rather be precise, or would you rather be accurate? I'd rather be accurate. And here's where I think you've got to be careful about how you write rules in valuation. Rules in valuation are driven by precision, not by accuracy. They're driven so you get the same result over and over again, even though it's a wrong result. It actually shows up especially when you value young companies, right? Because young companies, the reality is when you sit down to value young companies, there are lots of unknowns. In fact, everything is unknown. And most people just give up. They say, you can't value young companies. Why? Because there's too much uncertainty. That's not true. You can value them, but you can even value them accurately, but you cannot value them precisely. It requires that you make your best judgments. I'm going to cut to the chase here. I think that the payoff to valuing companies when you feel most uncertain is greater than the payoff to valuing companies where you know all the facts. Sounds weird, right? And I'll give you my simplest way of explaining why. Let's say that you decide to become a weather forecaster. Why you're bored of this appraisal business? Who wants to work with spreadsheets? You decide to become a weather forecaster. I'm going to give you 2 cities, and I'm going to give these cities from the US, and I'll give you some background. You can see why. Your first potential job is to go work as the weather forecaster in Honolulu, Hawaii. And your second potential job is to become the weather forecaster in Epping, North Dakota. I know you've never been to Epping. I've never been to. I don't want to go to Epping. So why did you pick those 2 cities? Here's what the contrast is. Honolulu, Hawaii has the most predictable weather in the United States. The least variation in temperature, and the least variation so if yesterday it rained, tomorrow it's going to rain as well. So if you go to Honolulu, Hawaii as a weather forecaster, you're going to be right a lot of the time because it's very predictable weather. Epping, North Dakota has the least predictable weather in the United States. The temperature shifts dramatically. You go from rainy days to dry days very quickly. So if your job as a weather forecaster is to be right, where would you rather be a weather forecaster? You're going to be in Honolulu, Hawaii, if you want to be right. If you want to be noticed, the reality is, who cares what the weather forecaster thinks in Honolulu, Hawaii? It's going to be sunny and 83 degrees tomorrow. It always is. I mean, it's like being the weather forecast in Mumbai and saying, it's going to rain tomorrow. I know. It rains every day. It's always 83 degrees and raining. There's not much payoff to listening to the weather forecast here. The payoff to being a weather forecaster, people listen to you when there's the most uncertainty about the weather. And I think about valuation the same way. I know you can value Coca-Cola more precisely than Uber. Why? You have a lot of history, you know what they do, they have a business model, it's easy to value. But guess what? Nobody cares what your value of Coca-Cola is because everybody else can value Coca-Cola precisely as well. It's companies like the Ubers and the Beyond Meats of the world where there's a lot of uncertainty that the payoff to doing valuation is greatest. So if you're doing valuation, don't stick with nice, mature companies. You might feel comfortable doing what you're doing, but those are exactly the companies we have very little to add to the process. Go where it's darkest. That sounds like a weird thing to say. Go where there's the most uncertainty. Value companies in the middle of crises because that's where the payoff to doing valuation is greatest. One final point and then we'll end for the day. How many of you do valuation as your living, is part of your jobs? Okay. If you're an appraisal, you think your job is to value companies, right? I'm going to throw 2 words at you. Now, after I've thrown the 2 words, I'm going to ask you the same question I asked before. We know what drives value. What drives value is cash flows, growth, and risk. You can dress it up with a discounted cash flow model. Intrinsic value is driven by cash flows, growth, and risk. What drives price? Demand and supply. What drives demand and supply? God only knows. It could be mood, it could be momentum, it could be any number of things. Value, price. You know that most of your valuation jobs are really pricing jobs? Your mission is to actually price things. You're using a discounted cash flow model, you're actually using the wrong tool. How do you price something? You look at what other people are willing to pay for similar assets out there. The starting proposition is, why would if you know the value of a company is 100, why would people pay 300 for it or 50 for it? Because the pricing process can lead to a very different number than the value process. In valuation, you can focus on cash flows, growth, and risk, and value the company. In pricing, you're looking at demand and supply. So if you use multiples and comparables, use EV to EBITDA in 15 companies out there, you are pricing a company, not valuing it. And you're doing it not because it's better or worse, but because that's your job. So the next time somebody comes and says, I want a number for my company, ask them, do you want me to value your company or do you want me to price your company? They'll have no idea what you're talking about. But if you want to sell your company, what do you want? Do you want a pricing or a valuation? You want a pricing. The thing is, they don't know the difference, so when you show them the value and it's too low, they say, that's not right, I can make 50% more than that. They're not being wrong. They're saying, I want a pricing. They just know how to ask you that question. So the next valuation mission, job you have, step back from it and say, it's my job to value the company is to price it. Because it'll make your job a lot easier if you know exactly what you're required to do. So think about those lessons as we go through, and as I said, valuation is, the other thing I wanted to say, and this is something that I believe truly, is valuation is not a science. It can never be a science. Valuation is not art. You can't make up stuff as you go along. Valuation is a craft. You know what the essence of a craft is? It's like cooking. How do you master cooking? You could do what my daughter does. She watches cooking shows on TV all the time. She can't cook a lick, but could tell you in the abstract how to make a souffle. She's seen it 20 times on TV. But you don't learn cooking by watching TV. You don't learn cooking by reading cookbooks. You learn cooking by cooking. And the first time you cook, what happens? Fire alarms go off, disaster strikes, and you're probably going to eat out that evening. I remember the first time I scrambled eggs. Nobody told me I was supposed to spray the pan. I scrambled the eggs. They looked good, but they were stuck to the pan. Eggs and pan went into the trash. I learned a very important lesson. Valuation is a craft. And the essence of a craft is you get better by doing more of it. I mean, 35 years into this process, I'm still learning. And I have to remember that. The door is never closed. You're never master of a craft. You might be able to do a particular dish really well as a cook, but there are other dishes you don't know. And that's something I have to remind myself, because there are times when I think I've got this. And then I say, no, you haven't got this. There's still. And I'll give you how this plays out. About 2 years ago, I remember I valued Uber. And just as I have, so 2017. I value Uber the way we traditionally value companies. Project our total revenues, total income, total cash flows, discount them back, come up with a value for a company. And I got some pushback. Some people didn't like my growth rate. But one of the pushbacks I got was from somebody I respect who said, you're using 20th century technology to value a 21st century company. And what he was talking about was the fact that I was using a discounted cash flow model to value companies that derive their value from users or subscribers or members. Let's face it, the big successful companies of today, if you ask them why are you successful, the numbers they point to are not revenues, cash flows, it's how many, look at how many users I have. Facebook's most impressive number is not their revenues and their margins, it's the fact that they have 2.3 billion users. That's mind-boggling. Apple, there are more than 1 billion people using Apple devices. So his point was you're using 20th century technology to value these companies that derive their value. And I thought, my initial response is, what the heck do you know about valuation? But then I thought about it and said, you have a point. But the problem you have is not with discounted cash flow valuation, it's with me. Because what does discounted cash flow valuation say? The value of an asset is the present value of the expected cash flows in the asset, right? Could I value a Netflix subscriber with a discounted cash flow model? Or let me phrase it differently. How would I value a Netflix subscriber with a discounted cash flow model? I'd first have to estimate how many years you would stay on a subscriber. Then what do I have to do? Project out how much you will pay as subscription revenues. Next, subtract out the expenses I will have to incur to keep you as a customer. And then discount it back at a discount rate that reflects the uncertainty I feel about those subscription revenues. You know what? I can value a Netflix. Can I value Uber ride? A little more difficult, right? Because Uber ride is a fixed premium, but they take rides. So with an Uber rider, I have to estimate how long you will stay on as a rider, how many rides you will take every month, how much you will pay. But I can value a rider, a subscriber, member. So I wrote back to him and said, your problem is not with discounted cash flow valuation, it's with me. I can value a user, subscriber. And he responded with one word, right. Piss me off now, and Because what was the subtext? You can talk about it, but you cannot do it. So I spent the next 2 weeks developing a framework for valuing an Uber rider. And I'll tell you what, it was the most productive 2 weeks that I spent that year. Because I used that framework then to value a Netflix subscriber, an Amazon Prime member, a Spotify subscriber. And I still use it to this day. Anytime you give me a user-based company, say, what's the value of a user, a subscriber, a customer? I now have the framework for valuing an individual user, a subscriber, or a member. In fact, it's now going to become my next book. I'm supposed to write it over the next few months, but I haven't started yet, but I'll get there. But my point is, I was able to do it because I was willing to listen. And that's something, as long as you keep the door open saying there's more to learn, there are things we can do better, this process can move forward. That's why I don't want you to get enshrined in a set of rules. Because you know what's going to happen? Those rules are going to become outdated sooner rather than later, and we're still going to be driven by the rules. A lot of valuations around the world are checkbox valuations. We basically, I follow the rule, I follow the rule. Look, it's following every rule. But it might be a terrible valuation. So I'm going to leave you with a couple of final thoughts, neither of which I should be throwing out in a valuation session, but I'll do it anyway. Don't take any of this stuff too seriously. Just remind yourself, it's only money. If your reaction is, what else is there in life? You need some spiritual counseling, but I'm in no position to give it. I remember about 6 years ago, end of one of my valuation classes, second-year MBA comes to me. She was a history major. Who usually, if you're a history major, you take what I call the strategic MBA route, which means you pick classes with the word strategic in their name, and you can go 2 years without ever seeing a number. But she ended up by mistake in my valuation class, turned out to be pretty good at it. So at the end of the class, she comes to me and says, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences, and then I said, oh no, my congratulations. And she said, I'm really scared. And I said, why are you so scared? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. A brain surgeon makes a mistake. Somebody dies on the table. You make a mistake, what's the worst that's going to happen? Somebody gets a little richer. Somebody else gets a little poorer. Think like a Marxist. You move some wealth around the world, just make sure that somebody's getting a little poorer is not you. That's the only condition you got to meet. Think like a Marxist, just let it go. Nothing in valuation is worth losing sleep over. I don't understand when people get angry in valuation discussions. What the heck is wrong with you? Nobody's dying. I mean, you want to use a different cost of capital, go ahead. I'm not going to stop you. This is not the end of the world. Final point, if you're ever given a choice between knowing everything there is to know about valuation and being lucky, which one should you pick? Pick being lucky. I hate to let you in on this, but I will anyway. This is a business where luck is the dominant paradigm. If you're lucky, all is forgiven. You can do really stupid things and get away with it. If you're not, you're completely and totally screwed. I don't care how much you know the art of valuation. Every valuation you do is just going to go downhill. So be superstitious, which I don't have to say. You're in India. Everything is, is a time right. And I don't fight it anymore. I used to find it incredibly frustrating that you wouldn't start a business till 9:30 on a particular day because that was the right time that you got. I just say, okay, if that's what makes you a lucky person, go for it. Because luck is the dominant paradigm in this business. So maybe you should visit a shrine tomorrow and offer to roll around if your valuations turn out to be right, or a mosque, or whatever you need to do to get the... You want to be on the right side of luck here, because that's such a dominant factor in what ends up happening that you don't control it. But that's about it. Thank you very much for being here, and hope you're